Hi, I'm Karen Stokes. I'm Finance Director for Creative Advantage West Midlands. I've been involved with the Creative Fund since 2004 when I became their Secretary and Accountant. And then subsequently, later on in 2010-11, I became Finance Director. You'd submit a statement of interest online to the fund. That would be reviewed by either myself or, more importantly, one of the investment managers. And the MD, or the chairman. Once we've had a look, if it was something that we felt was going to be a good investment for the fund and will produce a return in several years' time, and was a viable proposition, then we would obviously get back in touch in a positive manner and ask you to submit then a cash flow balance sheet and profit and loss forecast for 3 years. So basically, in layman's terms, we want to be able to see that the company is going to make a decent profit year on year. We do expect, particularly with startups, that the first year may be a loss, that it's got a good management structure, it's got a sensible idea, and that then in the future that we either then are able to both take dividends. It depends on the structure of the deal that we come to at the end, that we take dividends, us as the investee company and the owner directors or the shareholders, and that eventually then after 5-7 years that we exit. So that can either be via a company buys back its own shares, so the owners buy us back out, or it could be a trade sale that we all sell. A trade sale is when it's sold to a third party. Potentially a company's bought out. So for instance, if it's a computer company, it could be bought out by Apple or somebody like Microsoft or something like that, but obviously it's on a lot smaller scale usually. And then the company's valued, and then depending on our shareholding and the owner's shareholding, that's how much we would get back, which then we are always looking and striving to ensure that the companies do make profits and are sustainable, because then all our money goes back into the pot to make further investment into other new companies, startups, etc. The fund has got money from several sources. A little bit of it's a grant, the rest of it is, originally in the first instance was money given from ERDF, AWM, etc. That was then invested into companies, and primarily there was 2 main companies. One, we sold the shares back to the owners, so that gave us a good a return on investment, and another one was a good trade sale. So the whole company sold out to another, well, they were bought out basically, and that money is then put back in and reinvested, and we then use that money then to invest into more companies that hopefully will then eventually make the fund a profit. So that we have our own overheads, our own expenses, but we hope from dividends, etc., throughout, that then we'll all succeed. An investment manager will be appointed to a company once we've decided that it is a worthwhile proposition, and at that point all the services of the investment manager are free. The reason we appoint an investment manager to that company is to assist them to be 100% ready in investment readiness, really, for when they come to make a pitch to the board. So they will help them bring their accounts up to date if necessary. If it's a brand new startup, then help them with the forecasting. They'll help because the investment manager is knowledgeable on the next stage, which is the due diligence, once they've made the pitch, etc., and once the board has agreed that they would like to make an offer to this company. So they know the sort of things that we will be looking for due diligence, but they will basically make sure that all the ducks are in order, so that this company comes to us in a very prepared way. But they will also look at shareholdings of companies and things, and try and iron out any big problems, because ideally most investment companies will come and they want the money straight away. It doesn't always happen like that. So the more that can be done in preparation before the pitch and be prepared for questions that are posed to them, then it cuts down the time afterwards as well. But they're a very worthwhile ally really for the investment company, and we do find that even if we don't then make an investment, sometimes the investing managers will continue to help, maybe then on a paid basis, but they'll find that they're a great source of expertise. So if it's a company that's already trading, it needs to have had a good trading history and profitable, but they need to have the foundations in place. They need to, what I would be looking for is a good financial structure, a good way of monitoring their accounts, so a good package to be able to produce accurate accounts and timely, good team on the board, or a source, a source of people that they can rely on, good forecasting, so that we're not, and evened out forecasting as well, so if costs aren't shooting in one month you're going to make a major loss. Reliable sources of income, whether it be to demonstrate to us. So if it's a new startup business, we would only look as long at the business that's investing in it as long as they had got potential sales income, and from that we would be looking to see secured orders, etc., etc. So they need to have all that information. They need to be basically good knowledge of their own business, and also be aware of the authorities, be up to date with the PAYE, the HMRC, that sort of things. That they have to be a limited company anyway for us to invest into, so that things like annual returns are up to date, etc. So it shows a business head, and that's what I would look for as investment readiness. There's spare cash, basically, that at the bottom line, whatever profit they're going to make, but the cash is all important. Cash is king in my world. At the end of the day, if you haven't got your cash to pay your suppliers or your wages for your employees, if your terms of sale are far more than your terms of purchase, then you're going to run out of cash very quickly, and then without your staff you're not going to produce your sales, etc. So I would like to see a good margin of headroom of cash, so that if there is a shortfall in sales, which there always is no matter what happens, or certain things come in and the terms of payments are a lot quicker, then there is room to move. And I think that's so important in any business, basically startup and expansion, because you're not then focusing and spending all your time worrying about your cash. That's taking care of itself if you've got the right forecast and you've got enough cash in there as working capital, really. There will be a due diligence session. So the offer will go out in writing and it will be subject to certain conditions, and one of those will be obviously due diligence. And by due diligence I mean we absolutely scrutinise the business. Now if all the preparation, that's where the beauty of the investment manager comes in, because they should have hopefully ironed out any issues that will be underlying there, but sometimes they're not. It's throughout the due diligence that you can pick up different things. So we will look right from the shareholding, the shareholders, that there's no bankruptcies in there, that there's what else the shareholders are involved in, with the owner managers. Is it just that business they're going to be focusing on, or have they got something else that's going to take their time and then not allow them to concentrate on the business that we're going to be investing into? We would look at the authorities, so particularly our PAYE up to date. Again, is the VAT. We would look at VAT returns to make sure that the turnover that they're saying that they've produced is actually being reported on the VAT return. That's if they're VAT registered, obviously. We would always ask if it's trading already. We'd have had a set of accounts previously, and we would look for management accounts and statutory accounts to have a look at those. There's lots of things. Look at the fixed assets, whether the fixed assets are actually physically there. It's not very often, but we have had the case where things have come out the woodwork afterwards that need to be ironed out, and it can, if it's not satisfied, then it can unfortunately scupper the deal, really. So he could have done a fantastic pitch, but then there's things that have been kept from us, or we don't feel that the projections that have been presented to us are correct, and would you take different scenarios out. We may even ask the company to go away, and one of the questions from the board may be, and one of the things we would do is to say, you've got to put this person in place, or can you sensitise the information so that it brings it down to the worst case scenario, so we know that we're not asking them to fail by day one by underachieving. But there may be other things in there that need sorting out, issues over shares, shareholding in the business, etc. And also, we do have quite a rigorous investment agreement, which obviously before we would be doing warranties, warranty questionnaires, which also helps to draw out all these questions. So the investing company will know what sort of things are going to be asked to look at, and what sort of things will be scrutinised.